Hello, everybody. Welcome to Intermediate Accounting, 17th edition KESO solution walkthrough. This is problem 6-6. So the question used in this presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. This solution presentation is copyright 2019 to 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or Wiley. Okay, so let's go ahead and take a look at problem 6-6. So this is talking about the purchase price of a business, and we're talking, this is for Stacy McGill. She planted a new vineyard on 150 acres of land that she leases for $30,000 a year. She asked you as her accountant to assist her in determining the value of her vineyard operation. So the vineyard will bear no grapes for the first 5 years. In the next 5 years, years 6 through 10, basically be sold at $60,000 each year. For the next 20 years, 11 through 30, she expects the harvest will provide annual revenues of $110, but during the last 10 years, estimates it'll decline to 80. And then in terms of cost, pruning, fertilizing, and caring for the vineyard is estimated to be $9,000 during the years of production 6 through 40. These costs will rise to $12,000 per year. The relevant market rate of interest for the entire period is at 6%. Assume that all receipts and payments are made at the end of each year. Okay, so if we look at the different kind of components of this, right? So let's kind of segregate this out or separate it into the inflows and then into the outflows. Okay, so for the outflows, we know that there's going to be a lease payment. It's going to be $30,000 per year, years 1 through 40. Okay, so we know that that's going to be an outflow years 1 through 40. We also know that basically for years pruning, okay, this is going to be years 1 through 5. It's going to be at $9,000 during the years of 6 through 40. This will rise to $12,000 per year. Okay. In terms of the revenue inflows, right? So there's going to be no grapes for the first 5 years. Okay. So basically for the inflows, 0 years 1 through 5, and years 6 through 10, it's going to be $60,000 each year. Years 11 through 30, this is going to be at $110,000. And then lastly, we're going to have $80,000 per year for the last 10 years or years 31 through 40. Now, where this is interesting or where this question is a little bit different is that these are all different dollar amounts. When we have the annuity, present value of an annuity of $1, this is making a base assumption that, you know, we have the amount is going to be the same every single year. So I can't just take an average or anything else like that and apply it to these different amounts. Now, I'm going to do this kind of in a funky way, which may not seem, it's going to be a little bit more unorthodox, but hopefully we're going to get to the right result. So when it comes to the outflows, right, I know that this lease payment here, this is the easy one. If I take, and I'm on a 6% basis, so if I took 30,000, right, what is this going to cost me in terms of going back to today's dollars? So I'm going to take 30,000, and this is going to be at, this is the lease payment, and this is going to be the present value of an ordinary of $1, and this is going to be 40 periods at 6%. So if I come over here and I look at this present value of an ordinary annuity of $1, I've got 40 periods at 6%. which is going to be 15.04630. So this will be 15.04630. Okay, so the present value or the cost outlay in today's dollars for this, for the lease payment, is going to be $451,000. Let's go to the next one, pruning years 1 through 5. This is also going to be kind of easy too. So pruning years 1 through 5 is basically going to be $9 grand. And for this one, I'm just going to go ahead and use present value to ordinary annuity of $1. This is going to be 5 periods at 6%. So going over here, 5 periods at 6%, I get 4.21236. Okay. By the way, if you're in one of my classes, there's no way I'm going to give this question to you on an exam, primarily for the reason of you need Excel. Okay. Next one here, we got 12,000. But what's interesting here is that I've got years 6 through 40. So the way I want to kind of solve this, and this is what I was really thinking about, is like, let's figure out if I take this last one over here, I've got 12,000, and this is for pruning. What I'm going to do, though, is I'm going to say years 1 through 40. And this is going to be present value of an ordinary annuity of $1, 40 periods at 6%. And this factor right over here is 15.0463. Now, the problem is I'm assuming in this part over here that I've got years 1 through 5. So what I'm going to do with this one is I'm going to say, okay, this is for the full years 1 through 40. But now what I'm going to do is I'm going to back out the pruning of years 1 through 5. So I'm essentially going to remove that from the equation by coming over here and doing this 5 periods at 6%. So I'm going to remove the first 5 years out of this. That comes up to 50,548. So then now if I remove years 1 through 5 from years 1 through 40, this is going to give me years for years 6 through 40. Okay, so this one over here. So if I look at the present value costs, right? What is the cost of this over the 40 years? I'm going to have an outflow over here of 451. The outflow over 40 years here is going to be 37. And then the outflow over here is going to be a total of 130,007. Little bond tribute there. Okay, so my total outflows, the present value of my outflows is 619,308. Now, that's how much I'm going to have to pay out in today's dollars over the next 40 years. Now, let's go ahead and take a look over here at our inflows. So we're going to kind of use the same strategy, okay, for the inflows as we're doing for the outflows. Let's give ourselves a little bit more room. So for my inflows, 0 is 0, right? But let's go ahead and do years 6 through 10. So for years 6 through 10, what I'm going to do is I'm going to say, okay, my inflows in years 6 through 10 are 60,000 per year. So I'm going to go to the present value of an ordinary annuity of $1, but I'm going to do this actually for years 1 through 10. So, and this is going to be 6 periods. Excuse me, 10 periods at 6%. Okay. So if I come over here, 10 periods at 6%, this is 7.36009. So my present value of years 1 through 10 would be this amount here, but this is not right because in years 1 through 5, we didn't earn anything. So what I'm going to do is I'm going to deduct out years 1 through 5, present value of an ordinary annuity of $1, 5 periods at 6%. Oh, there we go. Go ahead and do this. Leaves 4.21236. So the present value of years 6 through 10 is going to be 441 minus 252, or 188,864. So this value here is 188,864. Okay, let's go to the next one. Okay, I've got 110,000. I think you kind of know where this is going. So over here, I've got 110,000, but I'm going to do this for years 1 through 30. Okay, so I'm going to use the present value of an ordinary annuity of $1, 30 periods at 6%. So right over here, 6%, 30 periods is going to be 13.76483. Okay. So my present value years 1 through 30 is going to be 1,514,131. But look what I did. I included the first 10 years in there. So what I'm going to do now is I'm going to have years 1 through 10, and I'm going to basically deduct this out. So this is going to be 10 periods at 6%. So this is going to give me 7.36009. I'm going to multiply this over. So then over here, my present value of years 6 through, no, sorry, present value of years 11 through 30 is going to be the difference between these two values. There is more than likely an easier way to do this. I'm just doing it this way because it makes more sense to me. Okay, let's go to the last one. We've got 80,000 years 1 through 40. So if I do years 1 through 40, again, I'm trying to get to the years 31 through 40, present value of an ordinary annuity of $1. And this is going to be 40 periods at 6%. Okay, so this is going to be years 1 through 40. But obviously, I did not hold it for that entire time. So I'm going to subtract out years 1 through 30. This is going to be 80,000. To be 102,518. So if I put this over here, my internet connection is unstable. This is what I get over here. Okay, so again, the way I did this was a little bit more unconventional, like a little bit unconventional, where I was taking the full amount of time and then subtracting the amount of time I didn't use it. So that's how I got to my values. So if we add up these different amounts, we get 995 and 903. So the question's asking us, what's the minimum price that she should be accepting? So we would have our inflows of 995, 903. So my total present value of these inflows is this right over here. My present value of my outflows, let's move over this to be a little bit more aligned. So my present value is going to be 319,906. My net present value is going to be 995,903. Over here, I got 376,595. What I am going to do is I'm going to show you what the textbook, or how the textbook went through and how they went through and did it. And hopefully if somebody wants to kind of send me their explanation and tell me what they think, That would be awesome because I'm sitting here trying to figure this out. I guess I'm getting old. Hopefully not on that island where you like age like really quickly every day. But not the so right here. Oh, interesting. So they netted out. They took. So they said, okay. So what they did a little bit differently is they said, they netted out. They did a net cash flow of each of the amounts, and that's how they get to 376, 596. And we pretty much got to the same number. We just did it a little bit differently. But they did this over here by looking at the net. So they're going to have negative 39 for the first 5 years. Then they have negative 18,000 for the next 6 through 10. And then 11 through, the numbers are changing. So again, they did it some way and, we're both getting to the same amount, but we just did it a little bit differently. So again, whatever is easiest for you. Okay, so let's go back over here. And right, we always have to say goodbye. It's like the Ouija board film, right? It's like you never play in the graveyard. All that good, fun stuff. Ouija Origin of Evil, scariest film of all time. Okay, so thank you, Wiley. Please don't forget to like and subscribe. Other solutions, ask in the comments. Okay, so again, thank you so much for watching this today. Have a great 2022, and I look forward to seeing you on the next video. Have a great one.